Beginning in April 2012, the government introduced an astonishingly generous tax incentive for individuals in order to help startup businesses get seed funding. The program is called the Seed Enterprise Investment Scheme, and it will allow individuals who invest up to £100,000 per year in a young company to potentially increase their return by nearly 20-fold, while at the same time potentially sheltering them from the loss of their money. This changes investing in a young private company from a high-risk activity with uncertain reward to a much lower-risk activity with hugely amplified potential rewards. SEIS is similar to the more widely known Enterprise Investment Scheme, and in fact is modeled on it, but it differs in a variety of significant ways. First, the investor gets income tax relief of up to 50% of the amount invested regardless of the investor's marginal tax rate. Second, investors avoid paying capital gains tax on any assets sold during the financial 2012-2013 year as long as they reinvest the gain in an SEIS-eligible startup in the same year. Like the Enterprise Investment Scheme, the investment also avoids capital gains tax if the shares are sold for a profit after 3 years or more. On the other hand, if the company should go bust, the investor may also be able to claim loss relief at their income tax rate on the investment, which has not already received some income tax relief. Let's work through an example. On an SEIS investment of £100,000, the maximum permitted each tax year, you would receive £50,000 as a reduction in your income tax liability. You could exempt £100,000 of capital gains by reinvesting in an SEIS, saving up to £28,000 of CGT. And finally, you could offset £50,000 of losses if the investment completely failed against your income tax liability, potentially saving a 45% taxpayer £22,500. This gives total tax relief of £100,500 on a £100,000 investment. In short, if the investment goes bad, you are potentially protected to 100.5% of your investment. If the company succeeds, you amplify the value of your investment tremendously. Let's see what happens. Let's assume, for the purposes of discussion, you invest £100,000 through SEIS and can take advantage of the capital gains tax relief, and that you sell the shares 3 years later for 2 times the value of your investment. Now that's a gross return of £200,000. In the normal course of affairs, you would pay 28% capital gains tax on the gain of £100,000, equaling £28,000 of tax, netting you £172,000. Thus, in the absence of SEIS, you would be investing £100,000 for a return of £172,000. But under SEIS, after income tax relief of £50,000 and the capital gains tax exemption of £28,000, you have effectively invested £22,000 for a return of £200,000. There is no capital gains tax on this. That is a 72% profit versus an 809% profit using SEIS. There are restrictions, though, on the types of firms that are SEIS eligible. The company must be unquoted, have fewer than 25 employees, and assets of up to a maximum of £200,000 at the point of investment. It must also be undertaking or preparing to undertake a new qualifying trade. Not all trades qualify. You cannot be more than a 30% shareholder in the company. Directors are eligible to claim relief, providing that they don't hold more than 30% of the company. HMRC will also run checks to make sure that a business hasn't just been set up merely to access the relief. And of course, the company can only receive £150,000 under this program. In short, whether you are a young company looking for early capital or are someone with a small amount of money that you would like to put to work, SEIS is undoubtedly one of the most interesting opportunities that has ever arisen.